Crypto is back. If you have been anywhere near financial Twitter, YouTube, or a WhatsApp investment group in the last year, you already know this. Bitcoin crossed new highs. Ethereum recovered. Altcoins that were declared dead are making noise again. The people who said crypto was finished are quiet. The people who never stopped believing are loud. And somewhere in the middle of all this noise, ordinary people who cannot afford to lose, are making decisions that will shape the next 5 years of their financial lives. Today, we are going to do something that most crypto content refuses to do: tell the full story. What is actually happening in crypto right now? Let us start with the facts, because the facts matter before the opinions. Bitcoin, after its brutal 2022 collapse, which saw it fall from nearly 69,000 USD to below 16,000 USD, has staged a significant recovery. By late 2024 and into 2025, it crossed and held above 90,000 USD, driven by a combination of factors that are worth understanding clearly. First, institutional adoption. The approval of Bitcoin spot ETFs in the United States in early 2024 opened the door for large institutional investors, pension funds, asset managers, hedge funds, to hold Bitcoin through regulated financial products for the first time. Second, the Bitcoin halving. In April 2024, the Bitcoin network underwent its fourth halving, an event built into Bitcoin's code that cuts the rate of new Bitcoin creation in half. Third, macroeconomic conditions. As central banks in the US and Europe began cutting interest rates in 2024, risk appetite returned to financial markets broadly. Crypto as a risk asset benefited from the same conditions that drove equity markets higher. These are real structural reasons for the recovery, not hype, not manipulation, or at least not only those things. But here's where the story gets complicated. The two cryptos. There are actually two crypto markets running simultaneously right now, and most people talking about crypto are conflating them in ways that are genuinely dangerous. The first market is Bitcoin, and to a lesser extent, Ethereum. These are assets with real infrastructure, institutional backing, regulatory clarity in major markets, and a 10-plus-year track record. They are volatile, yes. They can and do fall dramatically, but they have demonstrated the ability to recover and reach new highs. They are, by the standards of the crypto world, the closest thing to established. The second market is everything else: the altcoins, the meme coins, the new tokens, the projects with white papers and promises and communities and no underlying economic reality. This market is and has always been almost entirely speculative. For every Solana that survives and grows, there are hundreds of tokens that go to zero, not because of bad luck, but because they were never anything more than a mechanism for transferring money from late buyers to early sellers. The quiet comeback of crypto in the headlines is largely a Bitcoin story, but the money flowing into the market from ordinary retail investors is largely going into the second category, into altcoins and meme coins and new projects, because those are the things promising 10x, 50x, 100x returns. And that's where the losses are hiding. Who is winning? Let us be precise about who is actually winning in the current crypto cycle. Institutional investors who bought Bitcoin through ETFs at controlled, averaged prices are winning. They have professional risk management, diversified portfolios, and the financial resilience to hold through volatility. Early retail holders of Bitcoin and Ethereum who bought in 2018, 2019, or during the 2022 crash and held patiently are winning. They had conviction, they had time horizon, and they did not panic sell. Crypto infrastructure companies, exchanges, custodians, blockchain developers are winning. When volume goes up, they make money regardless of direction. Sophisticated traders with deep market knowledge, access to information, and the ability to act quickly are winning some of the time. Notice what these winners have in common. They entered early, or they have structural advantages, or they have the resources to absorb losses if the trade goes wrong. Now let's talk about who is losing, because this is the part of the story that the crypto community does not promote. The late retail buyer, the person who sees the price going up, feels the fear of missing out, and buys near the top of a cycle. This person has bought into the enthusiasm of the winning phase, but the winning has already happened. What follows, historically, is a correction. The meme coin chaser. Most meme coins and new altcoins in any given cycle end up worth nothing. The few that succeed create enormous survivorship bias. Everyone talks about the one that went 100x. Nobody talks about the 100 that went to zero. The leveraged trader. A 10x leveraged position on a 20% price drop wipes out the entire investment. The person who invested money they could not afford to lose. Emergency funds, rent money, school fees, business capital. When the market drops, and it will drop, they are forced to sell at the bottom. They cannot hold. Life does not allow them to hold. In Nigeria specifically, this last category deserves particular attention. The combination of naira devaluation, the desire for dollar-denominated returns, and the aggressive marketing of crypto platforms on social media has created a population of crypto participants, many of whom are using money they genuinely cannot afford to risk. Using USDT, a dollar-pegged stablecoin, to protect savings from naira devaluation is a legitimate, rational financial decision that many Nigerians have made. But this legitimate use case has become a gateway into speculative crypto trading for many people who did not intend to speculate. They downloaded an exchange to hold USDT. The exchange showed them price charts. The WhatsApp group started recommending tokens, and gradually the USDT that was meant to be a safe store of value became trading capital in a market they did not fully understand. This is not a Nigerian problem. It's a global pattern. But in Nigeria, the financial buffers that might protect a person in a developed market, stronger social safety nets, more stable employment, easier access to other investment options, are often thinner or absent. The losses hit harder. The honest risk assessment. Bitcoin held as a long-term position representing no more than 5 to 10% of your total investable assets is a speculative bet with a reasonable historical track record. It may go up significantly, it may fall 60% again. Both are possible. Ethereum, with similar position sizing and similar time horizon, carries more technology risk, but it also has more use case underpinning its value. Everything else, altcoins, meme coins, new tokens, DeFi projects, NFT-adjacent assets, should be treated as high-risk speculation, money you could lose entirely, money that should represent a small fraction of your financial life. For most people, this is a very small amount. What you should not do is move emergency funds into crypto, take loans to buy crypto, invest based on WhatsApp group tips, chase a token because someone posted their profits, buy because the price is going up and you're afraid of missing out. Fear of missing out is not a financial strategy. It's a psychological vulnerability that markets, crypto markets especially, are very good at exploiting. The bigger picture, here's the thing about crypto that both its believers and its critics often miss. It is neither the future of all money nor a worthless scam. It's a new, volatile, partially legitimate, partially speculative asset class that is still finding its place in the global financial system. Before you make any crypto decision right now, ask yourself one question. If this investment went to zero tomorrow, what would my financial life look like? If the answer is, I would be fine, then you are thinking about it correctly. If the answer is, I would be in serious trouble, then the position is too large. Crypto's quiet comeback is real. The gains are real. The losses are also real. They're just quieter because nobody posts about losing. Size it correctly.
Hold what you can hold through a 70% drawdown without panic selling. Ignore the noise. If you cannot do those things, if the position size that would let you sleep at night is too small to feel exciting, then crypto may simply not be the right tool for you. There is no shame in that. The boring investments are still building wealth while everyone is watching the charts. If this changed how you think about crypto, hit that like button and subscribe. Share this with someone who needs to hear it. Drop a comment. Are you in crypto right now?